All right, so let's dive right in today. We are going deep on Warren Buffett's 2008 letter to Berkshire Hathaway shareholders.
Okay.
Now, this wasn't just any ordinary year. This letter dropped right in the middle of the 2008 financial crisis.
Yeah.
Banks collapsing, credit markets freezing up, just a whole lot of fear in the
It
air.
was a wild time for sure. And this letter really gives us a glimpse into how one of the greatest investors of all time navigated that storm.
Yeah.
And, remember, Berkshire Hathaway, it's not your average company. I mean, they've got investments in everything from railroads and See's Candies to, insurance companies and everything in between.
Exactly. And they're led by Warren Buffett, the guy who's, famous for his long-term value-focused approach to investing.
Right.
So what I found really fascinating was despite all the chaos of 2008, Berkshire actually outperformed the S&P 500.
Mm-hmm.
It wasn't, a great year for anybody. Both Berkshire and the S&P 500 had their worst year in over 4 decades. But Berkshire's net worth only decreased by $11.5 billion, while the S&P 500 dropped even further.
That's a real testament, I think, to Buffett's philosophy, which he lays out pretty clearly in this letter. He focuses on these 4 key goals for Berkshire Hathaway.
Okay.
And the first is maintaining this really strong financial position. Think Fort Knox levels of security. They always have plenty of cash on hand and diverse income sources, so they're really prepared for anything.
So they're ready for anything.
Exactly. The second goal is widening the moats around their operating businesses.
Moats. Okay.
Yeah, think of a moat as a competitive advantage,
Right.
something that makes it really difficult for competitors to, steal their customers.
So they're not just building businesses, they're making them practically impenetrable.
That's a great way to put it, yeah. And then the third goal is they're always searching for new income streams. Buffett, he's not content to just sit still. He's always looking for these promising businesses to acquire or invest in.
Mm-mm.
And lastly, he emphasizes nurturing a team of exceptional operating managers.
Mm-hmm.
I mean, he knows he can't do it all himself.
Right.
So he surrounds himself with this top talent who can really run these businesses effectively.
So in a crazy year like 2008, how did these goals actually play out in practice? Did they just hunker down and kind of ride out the storm?
Well, they definitely played defense. That strong financial position was absolutely crucial when everybody else was scrambling for cash.
Yeah.
But they also made some strategic offensive moves. So, for example, they acquired Marmon Holdings, this huge manufacturing and service company.
So you were bargain hunting while everybody else was panicking?
Exactly.
Yeah.
They also made a series of smaller tuck-in acquisitions.
Now I'm curious, what is a tuck-in acquisition?
Yeah. So a tuck-in acquisition is basically when one of the subsidiaries buys a smaller company that kind of complements their existing business. It's kind of like adding a missing puzzle piece.
Makes sense. So they're taking advantage of the market turmoil to, grab some good deals.
Precisely. And they didn't stop there. They also made some pretty significant investments in their insurance portfolios. And this is where the concept of float comes in.
Now, I've heard Buffett talk about float, but to be honest, I'm still a bit fuzzy on what it actually means.
Yeah, float is really a key part of his strategy, so I think it's worth kind of breaking it down.
Yeah.
So float is essentially the money that insurance companies hold from premiums,
Okay.
but haven't yet paid out in claims.
Hmm.
So Berkshire's insurance businesses, they generate billions of dollars in float.
Right.
And Buffett gets to invest that money for Berkshire's benefit.
So it's like free money that they get to play with.
Well, not exactly free,
Right.
but it is a really powerful advantage.
Okay.
I mean, they actually generated a profit from their float in 2008.
Wow.
Imagine that getting paid to hold other people's money. But here's where it gets even more interesting, even with his incredible track record. Buffett admits to making some investment mistakes during this period.
Okay.
He even calls some of them dumb things.
Well, that's what I love about him. He's so honest about his shortcomings.
Yeah.
So what blunders did the Oracle of Omaha make?
Well, the one that really stands out is his investment in ConocoPhillips.
Okay.
He bought a massive chunk of stock when oil and gas prices were peaking.
Oh.
And then, you guessed it, energy prices crashed in the second half of the year.
Ouch. That had to hurt.
It cost Berkshire billions of dollars, according to Buffett himself.
Mm-hmm.
But what's important is what we can learn from it. Even the best investors make mistakes, especially in a volatile market like that.
Okay. I'm all ears for those lessons.
What's fascinating here is that this mistake really reveals a key element of Buffett's philosophy, and that's the importance of not relying solely on historical data or trends.
Mm.
The high oil prices at the time might have seemed like a good reason to buy,
Right.
but they didn't tell the whole story.
So we shouldn't just blindly follow trends or assume that past performance guarantees future results.
Exactly. And this leads us to another really important part of the 2008 letter, and that's Buffett's stance on derivatives.
Okay.
He's been warning about the dangers of derivatives for years.
Now, derivatives, I mean, they are pretty complex. Can you give us just a quick explanation for those who might not be familiar with them?
Sure, so think of derivatives as financial contracts, whose value is derived from something else like a stock, a bond, or even the weather.
Okay.
They can be incredibly complicated and risky.
And Buffett, he's not a fan?
No, he's been extremely critical.
Okay.
He believes that they increase leverage and risk in the financial system, and that they make it really difficult to analyze the true health of financial institutions.
Okay.
And he actually had a firsthand experience with this when he was unwinding a massive portfolio of derivatives held by General Re.
Okay.
This is a reinsurance company Berkshire acquired back in 1998.
How did that go?
It was a nightmare. It took 5 years to unwind the portfolio, and they ended up losing $400 million in the process.
Wow. That's a cautionary tale.
Yeah.
But weren't some people arguing that more transparency in the derivatives market could have prevented the 2008 crisis?
Yeah, that was a common argument at the time.
Yeah.
But Buffett didn't buy it. He argued that even with more transparency, auditors and regulators wouldn't be able to effectively manage the risks posed by these complex instruments. He really believed that the very nature of derivatives made them inherently dangerous.
So he's not just saying they're risky, he's saying that they're fundamentally flawed.
Yes. And this stance really put him at odds with a lot of people in the financial industry, particularly those who were pushing for bailouts of these institutions deemed too big to fail.
Right.
Remember the collapse of Bear Stearns?
Vividly.
That was a classic example of the mentality that Buffett was railing against.
So where does Berkshire stand on derivatives today?
Well, they actually hold a small number of derivative contracts,
Okay.
but each one is personally monitored by Buffett.
Okay.
He's not willing to let these instruments run wild.
Talk about hands-on management.
Yeah.
Okay, so we've covered a lot of ground here, from Berkshire's overall performance to Buffett's investment philosophy and his take on derivatives. But I'm curious to hear more about the specifics of their diverse businesses.
Sure.
Like, how are they actually generating revenue and profits during all of this chaos?
Yeah, that's a great question, and it takes us right into the next part of our deep dive, where we'll unpack the performance of Berkshire's 4 main operating sectors, starting with their regulated utilities.
Sounds like a plan. Let's see how these different businesses weathered the storm and what insights we can glean from their performance.
Okay.
All right, so we're diving into how the different parts of Berkshire's empire held up during the 2008 crisis, and let's start with their regulated utility business.
Okay.
Now, this sector is interesting because it tends to be a bit more insulated from economic downturns, right?
Yeah, that's right. People still need to, keep the lights on and heat their homes,
Yeah.
regardless of what's happening on Wall Street.
Right.
And that stability really showed in Berkshire's utility operations, especially with Mid-American Energy Holdings.
Okay.
They had a remarkably strong year.
What made them so successful? Was it just that steady demand?
It was definitely a factor. But Mid-American also made some really savvy moves, especially in the renewable energy space.
Okay.
They actually turned Iowa into the state with the highest percentage of wind power generation capacity.
Now, this is pretty interesting considering Buffett has historically been known for investing in more traditional industries.
Right.
He doesn't strike me as the green energy type, so what do you think prompted that move?
Well, it shows that even though he has that long-term perspective, he's not afraid to adapt and embrace new opportunities, especially when the economics make sense. Wind energy was becoming increasingly viable, and Mid-American was in a perfect position to really capitalize on that trend.
Yeah.
They saw the potential, they invested heavily, and it really paid off.
It sounds like they were ahead of the curve on that one.
Yeah, they were.
Okay, so aside from wind energy, what else was driving their success?
Well, they were also incredibly efficient operators.
Okay.
One example that really stood out to me was what they did after acquiring Pacificor back in 2006. They found that Pacificor had 98 committees meeting regularly.
Oh my gosh.
Can you imagine the bureaucracy?
This sounds like a nightmare.
So what did Buffett and his team do?
Yeah.
They slashed the number of committees to 28, streamlined operations, and they ended up generating and delivering more electricity with 2% fewer employees.
Wow. Talk about cutting the fat.
Yeah.
That's an incredible testament to their focus on efficiency.
It is.
Okay, so utilities were a definite bright spot for Berkshire in 2008. What about insurance? That's always been a core part of Buffett's strategy.
Absolutely. Insurance has been a key driver of Berkshire's growth for decades.
Yeah.
And 2008 was no different, even as many other insurers were struggling.
Hmm.
Berkshire's insurance operations continued to deliver really strong underwriting profits.
That's impressive. What's their secret? Is it just that float advantage we talked about earlier?
Float is definitely a huge part of it.
Okay.
But Buffett also credits their success to having, and I quote, the best group of managers in the insurance business. He specifically calls out the performance of Geico,
Ah, Geico.
led by Tony Nicely.
The one with all the gecko commercials?
That's the one.
Okay.
But don't let the gecko fool you.
Right.
They are a force to be reckoned with in the auto insurance industry.
Yeah.
Under Nicely's leadership, they've consistently gained market share while maintaining really disciplined underwriting standards.
So they're not just writing policies to anyone and everyone. They're being selective about who they insure.
Exactly. And that selectivity allows them to offer these competitive rates while still maintaining profitability.
Hmm.
It's a delicate balance, but they've really mastered it.
It's amazing how they've managed to grow even during a year when so many people were cutting back on expenses.
Right. And it's not just Geico.
Okay.
Buffett also sings the praises of Ajit Jain, who heads Berkshire's reinsurance division.
Hmm.
He calls him an extraordinary talent,
Okay.
and even jokes about writing to Ajit's parents in India to ask if they had another one like him at home.
That's hilarious, but it speaks volumes about Ajit's abilities.
It does.
So, insurance, another big win for Berkshire in 2008.
It was.
Now, what about their manufacturing, service, and retailing operations? That's a pretty diverse category.
It is. It's a real mixed bag.
Yeah.
We're talking everything from Dairy Queen and Fruit of the Loom to, Benjamin Moore Paints and NetJets,
Wow.
the private jet company.
Talk about a wide range of businesses.
Yeah.
So how did this sector as a whole perform in the middle of the crisis?
Well, like most businesses, they definitely felt the impact of the economic downturn, especially towards the end of the year.
Hmm.
But despite that, they still managed to achieve a nearly 18% return on tangible net worth.
So not a blowout year, but they held their own.
Right.
What do you think helped them weather the storm?
Well, their diversified portfolio was definitely a strength. When some businesses were struggling, others were able to kind of pick up the slack.
Right.
And just like with their other operations, Berkshire's focus on acquiring strong businesses with these competitive advantages, what Buffett calls moats, really helped them outperform in that challenging environment.
Okay, that makes sense. So we've covered utilities, insurance, and that massive manufacturing and retail sector. What's left?
We still need to talk about their finance and financial products operations.
Oh.
And this is where things get particularly interesting, especially in light of the 2008 mortgage meltdown.
All right, let's dive into that. This is where I think we can really glean some insights into how Buffett navigated the most treacherous part of the financial crisis. All right, so we've talked about how Berkshire's utilities, insurance businesses, and that massive manufacturing and retail sector all performed during the 2008 crisis.
Right.
Now, let's get into their finance and financial products operations.
Okay.
This is where things get really interesting, especially given the whole mortgage meltdown happening at the time.
Yeah, you're absolutely right. This is a fascinating area to examine.
Yeah.
And their biggest player in this sector was Clayton Homes,
Okay.
the largest company in the manufactured home industry.
Clayton Homes. So we're talking about mobile homes.
Exactly. Now, you might think that a company centered around manufactured housing would have been hit hard during the housing crisis.
Yeah.
After all, they were dealing with the same market forces that brought down so many other lenders.
It seems like they would have been right in the line of fire.
Right.
How did they avoid those pitfalls that trapped so many others?
Well, their success really boils down to their lending practices.
Go.
Unlike a lot of lenders at the time who were just throwing money at anyone with a pulse,
Right.
Clayton Homes stuck to these very traditional, almost old-fashioned lending principles.
Mm.
They insisted on substantial down payments.
Okay.
They rigorously verified borrowers' incomes, and they made sure that the monthly payments were genuinely affordable based on the borrower's actual income.
So they weren't relying on the ever-inflating housing bubble to keep everything afloat?
Not at all.
Yeah.
Their borrowers took out mortgages with the intention of actually paying them back,
Okay.
regardless of what happened to home prices. These weren't people speculating or flipping properties.
Right. These were people buying homes to live in.
So it sounds like they were operating in a completely different universe than the rest of the mortgage industry.
In a way, they were, and the results speak for themselves.
Yeah.
Their delinquency and foreclosure rates remain remarkably low, even as the rest of the housing market was imploding.
That's a powerful testament to their conservative approach.
It is.
It seems like common sense prevailed over Wall Street's, risky financial engineering.
It really did, and it highlights a really critical point that Buffett emphasizes throughout the letter.
Okay.
Sound lending practices are absolutely crucial, regardless of what the market is doing. You simply cannot build a sustainable business on speculation and risky bets.
It's a timeless lesson, and one that so many lenders seem to have forgotten during the housing boom.
Unfortunately, that's true.
Yeah.
But there's another layer to the story that's also very relevant to the financial crisis.
Okay.
Despite Clayton Homes' strong performance, their lending operations were actually threatened by the broader credit crunch. How is that possible if their borrowers are consistently paying their mortgages?
Well, it comes down to the unprecedented actions taken by the government to prop up the financial system,
Okay.
to prevent a complete collapse. The government stepped in to guarantee loans and provide this cheap funding to banks and other institutions that were deemed too big to fail.
So they were essentially trying to pump liquidity back into a system that had seized up.
Exactly. But the unintended consequence of these actions was that it created this massive advantage for those with government backing. Companies like Berkshire, despite their pristine credit rating and conservative lending practices, suddenly found themselves at a disadvantage.
It almost sounds like the government was picking winners and losers, regardless of how responsibly they were actually operating.
That's essentially what was happening.
Wow.
Buffett even points out, and I quote, "It was much better to be a financial cripple with a government guarantee than a Gibraltar without one."
That's a pretty stark assessment.
Yeah.
So even though Clayton Homes was doing everything right, they were still indirectly penalized by the government's intervention.
That's the irony of the situation. It really highlights the often unpredictable consequences of government intervention, even when those actions are taken with the best of intentions.
It's a reminder that markets are incredibly complex systems.
They are.
And even well-meaning actions can have these ripple effects that are really difficult to foresee.
Absolutely. And it underscores the importance of understanding the interconnectedness of the financial system.
Right.
What happens in one sector can have a significant impact on others, sometimes in unexpected ways.
Okay, so we've covered a lot of ground in this deep dive looking back. What are some of the biggest takeaways from Buffett's 2008 letter?
Sure.
What are some of the most crucial insights that our listener can apply to their own investment journey?
If we connect this back to you, the listener, and what you can learn from this, I think there are a few key things to keep in mind. First, patience and long-term thinking are absolutely essential, especially when times get tough. Don't let fear drive your decisions.
Right.
Second, always maintain a margin of safety.
Okay.
Have a cash reserve, don't over-leverage yourself, and be prepared for the unexpected.
Oh.
And finally, remember that investing is about owning businesses, not just trading stocks. Understand the fundamentals of the companies you invest in,
Right.
and focus on their long-term value creation potential.
Those are great points. It's remarkable how relevant this letter remains, even after all these years.
It really is. The principles that Buffett lays out are timeless, and they apply to any investor, regardless of their experience level or portfolio size.
So as we wrap up this deep dive, is there anything else from the letter that you found particularly thought-provoking? Something that wasn't explicitly mentioned in our conversation, but that you think is worth pondering?
There's one line that really stuck with me. It wasn't a major focus of the letter,
Okay.
but I think it speaks volumes, Buffett writes. The best moves are usually greeted by yawns.
That's an intriguing thought. What do you think he means by that?
I think he's suggesting that the most successful investments are often the ones that aren't flashy or exciting. They're the ones that are based on sound fundamentals, careful analysis, and a long-term perspective. They're not the ones that are going to grab headlines or generate a lot of buzz.
So it's about resisting the temptation to chase the latest trends or get caught up in all the market hype.
Exactly. It's about staying focused on the things that truly matter. Value, quality, and long-term growth.
That's a powerful message to end on. Thanks for taking us on this deep dive into Warren Buffett's 2008 shareholder letter. It's been a very enlightening journey.
It's been my pleasure. And remember, the full letter is out there for anyone to read.
Yeah.
It's a treasure trove of wisdom and insight, and I encourage you to explore it further.
We'll be sure to include a link to the letter in the show notes for anyone who wants to dig deeper. Until next time, happy investing.